Joining us from Stamford, Connecticut, to walk us through the roller coaster trade we've seen so far this week. RBS's head of strategy, John Richards, joins us. John, good to have you on the program. First of all, did you survive this week? You okay?
We did. Yep, we're in good shape.
Okay, so John, talk to me about what's happening on the markets here. I wouldn't say that jobless claims, a few thousand here or there, is that much to celebrate. Are you surprised by the gains that we saw overnight?
No, I'm really not. We are relieving now the supply constraints from the Japan earthquake in the automobile market, and employment and production is starting to pick up there. We also had a very encouraging employment report last Friday. That was sort of lost in all the equity turmoil and the turmoil around the debt ceiling and the downgrade, but we're starting to see modest signs of improvement in the economic numbers. They're not great, but they're not as bad as we've seen lately.
All right, so in your view, have we hit bottom then?
I think the stock market's putting in a bottom. This kind of volatility is not atypical of what you see in terms of price action, especially the sharp dips down followed by the very rapid run-ups afterward when you run out of sellers. I think, in fact, we are starting to run out of sellers, and the fairly positive fundamentals for American business are starting to take over again. I think somewhere around the 1100 level in S&P, maybe as low as 1050, but in that range, the market is starting to put in a bottom.
Okay, so what does that mean for stimulus and the expectations of what to come from the Federal Reserve? Does that mean no QE3?
Well, I think the Federal Reserve has made it very clear that they are going to do whatever it takes to avoid a double-dip recession in the United States. That was the message that I got from the last FOMC minutes. They have already told us that they're going to keep the funds rate at or near zero until the middle of 2013, and they hinted that other steps would be taken if necessary, and part of those other steps could well be QE3. If the economy can bottom here and growth can run between 2 and 2.5%, which is our core forecast, then I think the Fed stands pat with the policies that it's already taken.
All right, John, I guess during these tumultuous times when you still have, political factors at play in Japan, where do you go for safety? Where have you run for safety?
I think in terms of the equity market, there are defensive stocks, and in particular high dividend stocks that might look extremely attractive given that the whole market is down. There are individual stocks as opposed to what we call high beta stocks, or stocks that are highly correlated with the market as a whole, which also would be attractive. We have long-term interest rates coming down and down significantly with the Fed keeping the short-term rate pegged so low for so long. And that's going to make those dividend stocks look unusually attractive.
I bet. What about in the fixed income sector? I mean, take a look at the Treasuries, which is quite ironic, don't you think, considering we had a downgrade from S&P, but yet everybody ran into Treasuries, and hence we had record low yields. Is there still value in getting into these U.S. government bonds?
Well, it's been sort of paradoxical because it's rare when you have what's considered to be the world's least risky asset in many ways being downgraded in terms of risk. What we saw was a movement out of other risk assets into what was still the least risky asset, even though it was considered by S&P to be a bit more risky than it had been before. So Treasuries had quite a run. Part of it is also because, of course, the economy is weaker and the Fed is extremely accommodative. They backed up about 15 basis points today when equities rallied. We think that's a buying opportunity. Our stance in Treasuries is that the long-term trend will continue to be down, and we strongly recommend buying dips in the Treasury market.
Oh, that's interesting. Let me talk to you about risk, John, because I guess during the 2008 financial crisis, when governments banned short selling, that got a negative reaction on the markets. But then, you have these European nations like France, like Belgium, Spain, Portugal, Italy, looking to ban, I guess, short sellers, but yet we got a positive upside on the markets. Did that make sense to you?
I think there were other factors at work as well. I think the market had oversold a lot of the individual stocks, some of the bank stocks in particular, and it does not look like France is going to get an immediate downgrade in terms of the sovereign. And I think all of those forces combined today to touch off what was a pretty good rally in European stocks as well.
Okay, John, thanks again for sharing your insights. Good talking to you. Enjoy the rest of your week. That's John Richards of RBS, head of strategy, joining us from Stamford, Connecticut.